Tariffs back in play, then pulled, the Fed holding rates, gold and silver hitting record highs before, well, stocks steadily rising, then falling, then up again before another slump. Welcome to 2026, and boy, it's certainly been an eventful start to the year. What we're going to do in this video is take a look back at all the major events affecting the global market. It's easy to get wrapped up in all the sensational headlines or caught up in a recent trend. So we're going to break this down and look at what the real impacts are. No chaos, no noise, just context. And speaking of chaos, there's one man who just can't stay out the headlines. Of course, I'm talking about President Trump. This year kicked off with President Trump claiming that world peace is at stake as he continued his pursuit of Greenland. He highlighted that a number of major countries from the EU, including the UK, had visited Greenland for reasons that he said were unclear. And that sparked him to announce new tariffs of 10% starting on the 1st of February, rising to 25% from June 1st, unless his conditions were met. Happy New Year, right? So why does Trump want Greenland so badly? Well, geographically, Greenland sits between the East and the West, offering strategic flexibility from a military and defense perspective. World peace, right? Greenland also holds significant mineral wealth. Some studies suggest that the surrounding waters and terrain could hold up to 52 billion barrels of oil equivalent in resources. That's a lot. Then finally, and this also goes back to the location, with climate change reducing ice coverage, Greenland could become part of a key northern sea route in the future, and having leverage could be quite valuable. As you can imagine, these tariffs went down like a lead balloon with EU allies, and the markets responded accordingly. On January the 20th, US stocks saw one of their worst trading days since October last year, as the tariff threat rattled investors, with the S&P falling around 2.1%. And at the same time, European and global equities also weakened, as investors priced in the elevated geopolitical risk. However, just a few days later, things shifted. By January 22nd, markets rallied after Trump effectively backed down on the immediate tariff proposal and indicated that negotiations were ongoing. In the US, the S&P 500 gained roughly 1.16% as uncertainty eased. And in Europe, markets also cheered the news, with the FTSE 100 climbing roughly 0.6%. That week in January perfectly illustrates just how fast things can move in the stock market, and why it's generally a good idea to just block out the noise from the media unless you're willing to do the research yourself. Now, while tariffs and geopolitics grabbed the headlines earlier in the year, there's another giant steering markets behind the scenes, the Federal Reserve. On January 28th, the Fed held its benchmark interest rate steady in the 3.5 to 3.75% range, the first policy decision in 2026. Despite pressure from politicians to cut rates, the Fed instead signaled a very measured, let's wait and see approach. What's important to stress here is that not changing the rates is still a decision. It tells the market that the central bank isn't panicking. It's balancing inflation, jobs, and economic growth. It's choosing stability over drastic change. So what happened to the markets when the Fed made that call? On the day of the announcement, the reaction was surprisingly calm. And this again is a really important lesson. Markets don't just react to the event. They react to the tone and the expectations surrounding the event. When the Fed pauses and doesn't promise future cuts, something that investors were half expecting, it sends a message of caution and markets adjust accordingly. And here's the catch. While stocks barely flinched in light of this news, other assets told a completely different story. A strong US dollar, often supported by steady rates, can put pressure on other assets like precious metals, which don't pay interest. And speaking of precious metals, we can't talk about January without speaking about gold and silver and the ride they've been on. Both metals started the year on a blistering run, climbing as investors piled into safe havens amid geopolitical risk and shifting expectations around interest rates. At multiple points during January, gold hit record levels above $5,100 per ounce. And it wasn't just gold. Silver surged too, touching record highs near $122 per ounce as traders chased momentum and industrial demand. Simply put, those prices weren't normal. But then something interesting happened, and fast. As January wore on and markets began to reassess the overall picture, that precious metals rally ran into two main factors: profit taking and shifting expectations around interest rates. On January 30th, gold prices tumbled nearly 9.5% in a single session. Silver's move was even more dramatic. After hitting all-time highs, prices plunged nearly 28%. That kind of move, especially in silver, can tell you just how quickly sentiment can flip when trades become crowded. So why did this sharp rise and fall happen? Well, as I mentioned, two big themes collided at the exact same time. First, these trades have become crowded, and think of it like a vicious chain of events. As prices surged, more investors piled in, leaving a lot of tempting profit sitting on the table. And second, and perhaps more relevant, as rate cut expectations faded as the Fed held steady, that undermined the idea that low rates would continue to support precious metals. A firmer dollar and higher yields suddenly made non-yielding assets like gold and silver less attractive. Here's the real takeaway, and it fits perfectly with the theme of this video. Gold and silver didn't fall because the world suddenly became calm. They fell because the drivers that had pushed them up had shifted. In this case, profit taking, interest rates, and a slightly stronger US dollar all collided at the same time, resulting in a sharp dip. And that is why long-term investors don't get caught up in a single day or a single week. These kinds of swings, as violent as they feel in the moment, often reflect emotional or behavioral flows. They don't really change the fundamentals. So when you step back and look at the start of the year as a whole, the story isn't chaos, it's more about context. We had political headlines driving short-term volatility, a Federal Reserve choosing patience over panic, and markets constantly adjusting expectations in real time. Stocks moved, metals surged and then were pulled back, fear came in and then left just as quickly. And none of that means that the system's broken. In fact, it probably means it's working just fine. This is exactly why long-term investing isn't about paying attention to headlines or trying to predict the next price move. It's about understanding why markets behave the way they do and having a strategy that can sit comfortably within the uncertainty. So if January has taught us anything, it's this: volatility is just a cost of admission. It's not a sign that you're doing anything wrong. And going forward, this is how I'll be approaching markets: zoomed out, disciplined, and only really focusing on the details that actually matter. If you found this helpful, this will be an overview that we'll do every so often here on the channel. No noise, no panic, just clear perspective. Subscribe to the channel to make sure you stay updated, and remember to give the video a like while you're there. And before you go, check out this video over here that goes over some surprising details about age and investing. And on that note, I'll catch you in the next one, guys.